Have you ever wondered how the USA's money printing strategy is affecting the world economy? This question leads us to the heart of a complex and controversial topic that impacts us all. Let's break it down in simple terms. The USA's money printing strategy, more formally known as quantitative easing, is a monetary policy used by the Federal Reserve, the country's central banking system. The process involves the Fed creating new money to buy government bonds or other financial assets to stimulate the economy. Now you might be thinking, isn't creating more money a good thing? Well, it's not that straightforward. The act of printing money, metaphorically speaking, increases the money supply. But here's the catch. If the supply of money increases too quickly, it can outpace economic growth. This is where the U.S. government and the Federal Reserve play pivotal roles. The government can influence the money supply through fiscal policies, such as taxation and spending. On the other hand, the Federal Reserve uses various tools to control how much money is in circulation. One of these tools is setting the interest rate at which banks borrow money. By keeping these rates low, the Federal Reserve encourages banks to lend more, thus increasing the money supply. However, this method can lead to banks taking on more risk, potentially destabilizing the financial system. At first glance, this strategy may seem like a quick fix for economic woes. After all, more money can mean more spending, which in turn can stimulate economic growth. But like anything in life, there is a flip side. The increase in the money supply can cause inflation if it outpaces economic growth. Inflation, as many of us know, is the general increase in prices and the corresponding decrease in the purchasing power of money. This means the money you have buys a smaller percentage of a good or a service. This strategy, while appearing beneficial on the surface, has far-reaching global implications. As we delve deeper into this topic, we will explore how this silent economic destroyer affects economies around the globe, creating ripples that reach far beyond the borders of the USA. So what happens when the world's largest economy continues to pump money into its system? Well, the impact is far-reaching and multifaceted. At the heart of it lies the delicate balance of inflation and the value of other currencies. As more dollars flood the market, their value against other currencies can fall. This devaluation can disrupt international trade relationships, leading to a ripple effect across the global economy. But how does this happen? Let's take a step back and look at inflation. Inflation is essentially the rate at which the general level of prices for goods and services is rising. When the Federal Reserve prints more money, it increases the money supply. This excess money chases the same amount of goods and services, leading to price rises, or in other words, inflation. But inflation isn't just a domestic issue, it's a global one. When the US prints more money, it doesn't just affect the American economy. It also impacts economies worldwide. Remember, the US dollar is the world's leading reserve currency. When its value falls, it affects the value of other currencies. Now let's talk about trade relationships. Countries trade with each other to benefit from what others do best. But when the value of the dollar fluctuates significantly, it can disrupt these relationships. For instance, if the dollar devalues, American goods become cheaper for foreigners. While this might sound like a good deal for international buyers, it can hurt local industries in other countries as they struggle to compete with cheaper American products. Moreover, this strategy can lead to economic inequality. When inflation rises, the cost of living goes up. But not everyone's income keeps pace. This disparity can widen the wealth gap both within the USA and around the world. In essence, the USA's money printing strategy is like a stone thrown into a pond. The initial splash might seem contained, but the ripples spread far and wide, reaching places one wouldn't initially expect. The ripple effect of this strategy is felt worldwide, often causing unforeseen consequences. But what exactly does inflation mean for the average citizen? For starters, inflation is an economic term that describes the general increase in prices over time. Think of it as a silent thief, stealthily eroding the purchasing power of your money. Imagine for a moment you're at your favorite coffee shop. You've been buying your daily cup of joe for $2. Suddenly, the price jumps to $2.50. That's inflation at work. The coffee didn't become better or bigger, but the price increased. The same amount of money now buys you less. This is the crux of inflation, a decrease in the purchasing power of money. Now let's dive deeper into the USA's money printing strategy's role in this scenario. Picture the economy as a massive ocean and the money supply as the water in it. When the Federal Reserve prints more money, it's like adding more water to the ocean. If the economy doesn't grow at the same pace, we'll end up with more money chasing the same amount of goods and services. This imbalance can cause prices to rise, leading to inflation. This isn't just a theoretical concern, it's a very real possibility. By stimulating the economy and keeping interest rates low, the Federal Reserve has increased the money supply. If this outpaces economic growth, we could see inflation rates rise. But it's not just about paying more for your coffee. Inflation affects everything from the cost of living to the value of your savings. It can make planning for the future difficult and can hit those on fixed incomes particularly hard. Inflation, while a complex economic term, is a very real and tangible effect of the USA's money printing strategy. It's a silent destroyer, quietly diminishing the value of your money. And understanding it is the first step in navigating its potential impact on your life. It's not just the Federal Reserve that plays a part in this strategy. Indeed, the role of banks and the government in the USA's money printing strategy is crucial. They are the two primary agents that can significantly influence the money supply and potentially contribute to inflation. Let's start with banks. In a nutshell, banks create money every time they lend. When a bank issues a loan, it doesn't take the money from someone else's account. It simply adds the amount to the borrower's account, effectively creating new money out of thin air. This process, known as fractional reserve banking, significantly increases the money supply. On the other side of the coin, we have the government. The government influences the money supply through its fiscal policies, such as taxation and spending. When the government spends more than it earns in taxes, it borrows the difference by issuing bonds. Banks and investors buy these bonds, pumping more money into the economy. Moreover, the government can stimulate the economy by cutting taxes or increasing spending, which puts more money in the hands of consumers and businesses. However, if these measures outpace economic growth, they can lead to inflation. So, you see, the government and banks have a symbiotic relationship. Banks create money through lending, and the government borrows this money to finance its deficit. Together, they contribute to the increase in the money supply. But the story doesn't end here. Other factors, such as interest rates and regulatory policies, also influence the money supply and inflation. These elements intertwine in a complex web of economic interdependencies, making it hard to isolate the impact of any single factor. In conclusion, while the Federal Reserve's money printing strategy has been in the spotlight, it is essential to understand that the actions of banks and the government also play a significant role. They are integral parts of the monetary system and have a substantial influence on the money supply, inflation, and ultimately, the global economy. The actions of banks and the government play a significant role in the USA's money printing strategy and its global impact. As we look to the future, the long-term implications of this strategy become increasingly clear. The USA's money printing strategy, a maneuver intended to stimulate economic growth, has a ripple effect that reaches far beyond its borders. It's like a stone tossed into a calm pond, causing waves that disrupt the natural order of things. This metaphorical stone, the increase in the money supply, is causing a global economic disturbance that we can't afford to ignore. Imagine the world's economies as a tightly woven fabric. Each thread represents a different nation, and together they create a complex tapestry of trade relationships. The USA's money printing strategy tugs at these threads, loosening the intricate weave and potentially creating a tear that could unravel the entire fabric. Trade relationships, painstakingly negotiated over decades, could be put at risk as other nations grapple with the devaluation of their own currencies against the dollar. But the impact doesn't stop at disrupted trade relationships. The amplification of social divisions and economic inequality is another troubling consequence. As the value of money decreases, the cost of living increases. Those on the lower rungs of the socioeconomic ladder often bear the brunt of this. Inflation can mean the difference between scraping by and sinking under. In nations where the social safety net is already stretched thin, the effects can be devastating. Economic inequality becomes more pronounced as wealth is concentrated in the hands of a few, leaving many others struggling to keep up. This can lead to social unrest and instability, further complicating the global economic picture. In conclusion, it's clear that the USA's money printing strategy has far-reaching implications. It's a complex issue that intertwines with other factors, making it a challenging puzzle to solve. But one thing is certain: it's a silent destroyer that has the potential to cause significant long-term damage to the global economy. The long-term global impact of the USA's money printing strategy is a complex issue that requires careful consideration and ongoing analysis.